Good morning, Trader First Year. This is the first trade that I've put out in a while. So 4/5/2021, new options position, Strangles. It's going to be puts and calls, taking advantage of a fall in realized volatility and overall market dispersion. The TLDR, want to avoid the small print, condensed version of the trade is pretty straightforward. It is a short vol via short front dated options and a short gamma profile. End goal is to make $3,000 in 2 weeks. The potential profit is about $3,000 in 2 weeks. The exposure is going to be 1.1 million for 2 weeks. Videos going to be coming shortly. Volatility expectations. Markets are implying a move of 1.12% up or down on the S&P 500. Markets have realized a move of 0.92% up or down. The difference between what market makers are implying and what has been realized has tightened. The spread widened to 317 basis points. The VIX is expected to move 6.22%. The VIX is currently at 1786. The VIX price range is between 1897 or 18.97 to 16.81. The put-call gamma imbalance has been reset but is likely to favor call buying. The S&P is expected to move 1.32% up or down, which means the S&P could rise 14.5% or 11% or fall 11% above its 200-day moving average, which is 3,553.29. The S&P traded above its 50-day moving average of 3,887.97. Full summary and rationale for the trade. The end of quarter passive fund rebalancing along with slight or no substantial changes in market positioning will give market makers a chance to remain relatively range bound during the week starting 4/5/2021 and ending on 4/19/2021. The rebalancing post-quarter end will provide traders structural opportunities to profit from selling elevated convexity into the market via put write and call write strangles, which are 5% out of the money. Traders will assume to act like insurance companies for a week, selling premium, writing policies, and keeping the profit at the end of the week. Brief on the trading suggestion. Due to a fall in realized volatility and implied volatility through April, May, and June, we will temporarily be in a period of reduced swings up and down. The current market environment is favorable for traders looking to sell convexity via short straddles, strangles, call overriding, put writes, and other short vol strategies to capture alpha. The rationale for the trade. Falling realized volatility presents traders with the perfect opportunity to profit from selling volatility back into the market. A low return environment and possible negative curve with the Federal Reserve balance sheet expansion as a useful backstop invite investors to re-engage in seeking to exploit timely carry trades by selling volatility back into the market. The risk for the trade. The risk is any large increase in realized volatility which causes the equity market to move up or down greater than 5% to 7% over the trade's 2-week duration. This would create substantial problems to the right or left side of the distribution curve. What we would like to happen is movement of greater than 4% or movement of less than 4% and movement of greater than -4% for the full 2 weeks. Naked options, level 3 required to write strangles on Google and Amazon. You'll have 2 contracts, one on each. Or not actually 2 contracts, but you have actually a total of 4 contracts on each of those 2 positions. So as you can see here, I have the stock ticker. It's going to be the SPY, the Qs, the Dow, and Google and Amazon. The expiration date is going to be 2 weeks from today, which is 4/16, which is a monthly expiration, 4/16/2021. The strikes, as you can see, are going to be 5% out of the money on the underlying price as of the close of business on Friday of last week. And you can see the options pricing. You will be collecting that income, and it will generate, using the S&P as an example, will generate $71 on the put side and then $15 on the call side, which you'll be collecting and taking in. Because you'll have one contract, which is 100 shares, that's going to give you an exposure to the S&P of about $40,000. In total, it's about $80,000 between the 2 contracts that you're going to be selling. The break-evens here are 380.29, and 420.15. These are prices as of 8:30 a.m. and these are again like 5% out of the money strangles on the tickers. Preemptively answering a question about the worst case risk these trades face. What is the worst that could happen in a COVID generated zombie apocalypse in 2 weeks? How much do you owe under a large move to the left side of the distribution curve? What would happen in a market meltdown selling these strangles? And how much would traders using level 3 put writes owe? I don't think this is likely to happen, but it's a good question to highlight the risk associated with selling options in general and selling strangles in particular. So what you'll see highlighted is the same graph that you saw above. The only difference with this graph is that as you scroll over past exposure, the 30% down indicates the left tail risk associated with the market falling 30%, and what would the price of the put option that you sold be? As you can see for the S&P, using that as the example, would be $72. So you initially collected only 71 cents, but due to the massive fall in the equity market and the massive rise in realized volatility due to this unbelievable COVID-19 generated zombie apocalypse, the price ratchets up all the way to $72, which means that you would have to cover, you would need $7,290 to cover that position. And this again is the worst case hypothetical scenario. So the news first, traders would collect all the call right premium, a whopping $1,254, goes into their brokerage account on the at the close of business today. I'm sorry, at the very end of well, it goes in today. But the bad news first is it's a COVID-19 zombie apocalypse, and zombies do exist. 2, a trader would need about $105,000 to cover the naked short puts if the market fell 30% in the course of 2 weeks. Anything is possible, but you would need to see the VVIX spike upwards of 400. You'd also need to see the VIX implied spike move closer to 350, which based on current market pricing is not something that anyone is imagining happening. Why? Well, there's circuit breakers that typically kick in under these sorts of scenarios at different points. So it's unlikely that we'd see a 30% drop in 2 weeks, but this just highlights the risk associated with selling convexity or selling or being short options while you're collecting income on those options. Typically, as most people know, implied volatility is almost always going to be a little bit almost 95% of the time to 98% of the time, it's always going to be higher than what's realized. So if there is a gigantic spike in realized volatility, typically you will have to cover. But over the course of these 2 weeks, it looks very likely that given the new economic scenario and situation that we will see volatility decrease. So good luck on the trade. Thanks for listening.